Good afternoon, everybody. We shall wait a few more seconds while people join this exciting webinar. We have individuals from all over the world, and we had more than 300 registrants. So hopefully they can join in the near future. Right, I'll start. My name is Carl van Randwyk. Good afternoon, and welcome to this webinar about financial crime risks in the insurance industry. I'm the Chief Growth Officer at Themis, and it's a privilege to be moderating today's discussion, which we are organizing jointly with Dow Jones and Themis. Financial crime in the insurance industry is on the rise, driven by malicious actors seeking to profit from new vulnerabilities and exploit gaps in the risk management frameworks. Certain insurance products are highly susceptible to money laundering threats, whereas the sector as a whole is at risk of fraud, cybercrime, bribery, and corruption. In light of these challenges, a comprehensive anti-financial crime systems and controls are more important to the industry than ever before. Themis and Dow Jones have partnered up to research red flags, challenges, and motivations and expectations related to financial crime in the sector. As part of our research, we have interviewed a number of insurers and insurance brokers to gauge their views about the current threat landscape. We found that the prioritization of financial crime issues in the insurance sector tends to be mixed, with both the maturity of regulation and the cultural emphasis placed on financial crime often lagging behind the approach of other sectors in the financial services industry. To bring our research to life, we wanted to explore some of its key themes with a panel of industry experts who have extensive experience leading or advising financial crime teams at insurance firms. So I'm honored to introduce our panel of distinguished guests today. Firstly, Marie Bolton Jones. Marie is responsible for leading the financial crime team at Willis Towers Watson as part of the firm's compliance function. Prior to becoming a financial crime prevention and compliance expert, Marie specialized as insurance and reinsurance legal counsel in international law firms and corporates. Marie has over 25 years of legal investigation, advice, and defense experience, and is a qualified lawyer in Australia and the UK. Linda Baskett has been a financial crime director for all of Aon's UK entities since 2016. She has 16 years of experience in financial services, covering both financial crime prevention and data protection information security. Prior to moving to the private sector, she worked in the public sector as a trained financial crime investigator and managed intelligence that supports financial crime detection. Steve Solazzo is a director of risk and compliance at Dow Jones. He has over 10 years of experience in the US Bank Secrecy Act and AML compliance across various large financial institutions, such as Boney Mellon and JP Morgan Chase, and also has managed a team across tasks with KYC reviews of high-risk accounts. Steve leverages his industry experience to help Dow Jones clients stay ahead of the ever-changing regulatory curve. And then Mark Lopez. He is a senior manager with Accenture's UKI risk practice, specializing in financial crime prevention. He has over 17 years combined experience in asset management, corporate banking, and the insurance sectors, having worked at Fidelity, MUFG Bank, Aon, and Arthur J. Gallagher insurance brokers before moving into consultancy. That's our fabulous panel of experts. And we hope that you will join us in a really interesting discussion. I'd like to start off with an audience poll with the following question. In your view, which of the following financial crime threats is the insurance industry most exposed to? While the poll is going on, I'd like just to give some update on our research, where we analyzed all the threats that you can see on your screen. However, what interested us most was some of the recent statistics related to insurance fraud. According to a report published by the Association of British Insurers in September 2020, insurers uncovered a new scam every 5 minutes in 2019, amounting to a total of 1.2 billion sterling worth of fraud claims detected that year, and fraudsters are really often one step ahead of the game, and that is very concerning. But anyway, poll results are coming in, so let's see what what everybody has said. Well, we've got in excess of 100 responses, and the results seem to show that the most prevalent view of everybody is that fraud is of the highest concern for everybody, followed by money laundering, sanctions, and cybercrime. Interesting that terrorist financing does not appear as an issue at the moment. Fascinating. So let's get cracking. Marie, if I can turn to you first, please. I'd like to gauge your views on the most pressing financial crime risks facing the insurance industry at the moment. The industry is, of course, made up of diverse players. How do these risks differ between different insurers and insurance brokers? And also, how do they vary based on the size of the firm?
Thanks, Carol. I think the poll was really interesting because I'd actually put as the top risk facing the insurance industry as being sanctions, and whether that is exposure to list-based sanctioned actors, but also facilitating trade, which is sanctioned for sure. That would be what I would consider the top financial crime risk facing the insurance industry. I'm quite pleased to see no results for people thinking there is no financial crime risk, so we're already on a good start there. I think we're touching on sanctions later, so I'll just put that down as a definite risk for insurers and brokers alike, with different levels of risk between insurers and insurance brokers, given their different roles in the sanctions chain. Interestingly, I kind of vary from the audience because I'd had bribery and corruption as the next most significant financial crime risk, and it's certainly an obvious one, at least for brokers in the UK, as by now a number of brokers have been fined by the FCA, the UK regulator for brokers, for not managing bribery and corruption risk via third parties. And interestingly, most for acts before the UK Bribery Act, which is quite interesting. So in a global broking business, third parties are a key part of the model, from producing brokers embedded in particular geographies who are wanting to access markets in other geographies, or local servicing brokers who are required to provide a global and local service, co-broking due to different expertise between firms or different strengths of relationships with particular carriers, all the way up to the sort of highest risk category, which you see in most enforcement actions, who are introducers who are appointed to bring prospects to a broker. I think all of the brokers, whether fined or not, have substantially needed to improve our risk assessment and review of third parties following the FCA focus. I know WTW certainly has. We do a risk assessment for every third party, which considers a number of factors, such as the country, whether they have their own ABC policy and framework to support that policy, so that we can be comfortable that they themselves manage their bribery and corruption risk, which exposes us as their associate, as having a relationship with them, looking at the percentage and value of the commission or fee that they will be paid for their role in the transaction, and most importantly, can their services be clearly described and evidenced. And then we have increasing levels of review and approval as the risk increases. And we don't just do that once. It's not a one and done risk assessment and review. We annually reperform the whole process for all but the very lowest risk third parties, who tend to be other strongly regulated brokers, who they are reviewed every 2 years. On bribery and corruption, gifting entertaining is also a significant bribery and risk. broking and insurance, even in 2021, is a relationships-driven business. It's relationships with clients, relationships with markets, relationships with brokers. And that means that gifting and entertaining is a much more significant BAU business activity than might be seen in other industry sectors. But one which I thought was going to surprise some in the audience until I saw the poll is I actually think money laundering is a very significant risk. Not so much because the industry generally is a target for money laundering, or that there are AML regs for particular products such as life insurance, but due to the wide variance in AML laws and regs that could apply to insurance parties in general insurance, regardless of any real live transactional risk. You know, there are varying maturity of AML regulatory regimes from nothing at all, principles-based, risk-based, all the way up to bank-level prescriptive requirements. We have in WTW, which is a global broker in 146 countries, we have those regulatory requirements across all of our company. So the challenge, particularly if you're a global or a multi-regional company, is how do you design and run an operationally efficient and effective framework to manage and meet so many different standards? As for the variance amongst the size of the firm, again, it depends upon your regulator. It may be that all firms are subject to the same regulations, regardless of any other factors, or they're subject to the same regulations, but they have differing levels of supervision and reporting. So less frequently supervised firms, or not at all supervised firms, the compliance team doesn't have the stick of active regulatory interest and penalties to persuade company leadership of the risk and the need to invest in a framework. But they're still subject to the regulations, and they can still be investigated, and they can still be fined. So I think the challenge is there for all firms due to the variance and number of regulations, but it is even greater if you're in a small firm who may not have the resource required to manage those regulatory requirements and the risk, and have to find more, business positive ways to secure that resource rather than relying on regulatory exposure and the threat of fines or reputational damage.
Thank you, Marie. That is quite a gallop through the different issues, and but it does highlight that the sector, both the insurers and the brokers, are having to assess the different financial crime threats. It's not just one; it's numerous, and then put the different processes and procedures in place. And as you rightly say, it's not just once. When you onboard clients, but it's a continual process annually. Yeah, Linda, if I can turn to you now, inevitably, financial crime risk in the insurance industry also varies depending on the type of insurance products being sold. For instance, life insurance is generally seen to be more exposed to money laundering risks than many other products. Could you possibly comment on some of these differing vulnerability levels, perhaps using some examples of different products?
Yes, I was also interested to see money laundering coming up so high in the poll. I think we've historically thought that money laundering in general insurance isn't such a big deal, and perhaps the population of people responding on a money laundering front were from the life insurance sector. I mean, one thing I would say is when you look across the suite of all financial services products available, insurance products tend to be at the lower end of the spectrum of risk. Traditionally, life insurance or protection related policies have always attracted a higher level of money laundering risk. Typically, sort of whole of life policies are the highest risk of those, where they have it's just the vulnerabilities in the product come from things like having the ability to trade it, surrender values, surrenders. You can surrender it as well. So that's where the risks start to come, because you have your traditional in and out that you require in a money laundering setting. Term insurance, income protection, products such as critical illness cover, long-term illness cover, they tend to be categorised in the UK by the JMLSG as a reduced risk. And that's predominantly because they only pay out on a verifiable event, usually an independently verified event. So you would need doctors to confirm, possibly more than one sometimes, to confirm that somebody was unable to work or had a particular critical illness. And then often payments don't tend to necessarily go back direct to the client. So again, in that typical chain of money in, money out, there are things blocking that, and it makes it more complex. I think one thing that we shouldn't forget is the fact that despite insurance products not really lending themselves to the layering or the initial placement stages of money laundering, they still, most of us still have to follow some sort of rules or laws like the UK Proceeds of Crime Act. So we still should be looking at our clients and understanding where they're getting their money from. And I think that point particularly links back to the poll around fraud. Because while there's no obligation in the UK to report fraud, not under sort of AML regs, there are a moral obligation to report it through action fraud. But if you then realise that a claim has been fraudulent afterwards and that claim has been realised, you're then coming into the territory of the Proceeds of Crime Act, where there's criminal proceeds that have been paid out at that point. So I think it's important for all of us to kind of keep an eye in that space. But again, yes, I'd agree with Marie, sanctions as a big risk. And we are also, as general insurers, covered by some of the UK laws on the Counter-Terrorism Act. And I do think that is an area throughout my career where I've not seen the level of focus that I would expect to see. I just think that's possibly an area for future where regulators are going to expect us to do more, but it does sort of sit in the background. And other than screening our clients against known terrorist watch lists, we aren't really, I don't think, looking for the patterns, not in the insurance world. Insurance providers may be doing it, but definitely not in the broking world, looking for those patterns of terrorism financing.
Right. That's really interesting, as you say, looking for patterns of behavior, transaction flows, etc. That's much more with the insurers than it is with the brokers. Steve, if I could just turn to you, please. The banking and insurance sectors share similarities, but also numerous differences when it comes to inherent vulnerabilities and financial crime risk management priorities. You work with a diverse range of players within the financial industry. So I was wondering if you could comment on how the threat landscape has changed for all during the COVID-19 pandemic. Are there any lessons learned that you can share with us as we hopefully start emerging from our restrictions?
Sure. So I think COVID-19 really brought to the surface things that have really always been there. Number one on that list is the need to really accelerate automation in financial crime risk management. Years ago, and even in many circumstances today, when you get a deferred prosecution agreement, of any kind of material finding, the thought is kind of throw bodies at the situation, bring in contractors, bring in consultants. That really needs to go by the wayside. It's especially with COVID and what it how it brought staffing levels and really disruption into that kind of model. And I would argue that when it comes to financial crime, the insurance industry is even more susceptible to external factors such as economic uncertainty, political instability, and certainly global pandemics. Increased automation can bring greater resiliency against these threats for obvious reasons. And really a key aspect to any strong compliance program is the ability to have processes and controls that are consistent and repeatable. Of course, that they're accurate and doing the right thing and obviously working, and obviously based on varying risk levels, but they want to see if there's a process. And again, that process can be repeated. It's consistent across geographies, consistent across different divisions and units of the bank, of the insurance company. So without that, you kind of fly by the seat of your pants, so to speak, where any kind of external factor could really throw that off. And when these things get upended due to COVID, due to external factors, that uncertainty looms large. And really, the fact of the matter is uncertainty and consistency, they don't go well together. So I think seeing a greater emphasis being placed on business continuity plans, on automation, can really definitely bring these programs to the next level. I can say for questions that we get, and certainly throughout the industry, there's much more of an emphasis on business continuity and the way we're going to react, and the companies will react, and banks and all FIs will react in a similar situation. I think at one point, not too long ago, and certainly still today, a lot of FIs are averse to automation. They see it as the robots are going to take over. There won't be a need for compliance professionals. That's absolutely not true. I think we'll get to that a little later on. But you need to have those controls. You need to have the automation in place, not just because of more data, not just because it's best practice, but you can't just throw bodies at the problem anymore. You can't have processes that aren't automated in the face of disasters like COVID.
Yeah. Thanks, Steve. As you say, the increased use of systems and automation is going to be the way forward, particularly if you're looking for increased resilience, but also to be able to see patterns in transactions, as Linda identified earlier on. Mark, if I can turn to you, during the research interview that our team conducted with you, you highlighted the bribery and corruption risks facing the sector, and particularly insurance brokers as intermediaries. Could you possibly tell us a bit more about this risk, and what do you think anti-bribery systems and controls are improving across the industry?
Yeah, sure. And obviously, I'm conscious Marie touched quite a bit on the ABC risk element in the opening question, so I'll try not to repeat what Marie's already said. But absolutely, in terms of the insurance broking sector, third parties or local agents, introducers, acting as contacts for the potential insured parties is I think one of the major risks, and I echo Linda and Marie in sort of being surprised that ABC kind of featured as low down as it did, although it is a risk more specific to the broking sector, I think, than the insurers. But we've seen historic enforcement actions, and again, Marie alluded to those, for systems and controls failings for a number of the larger brokers by the UK regulator, the FCA, for firms not actually having the right processes in place. And whilst these are now over a decade old in most cases, the enforcement actions, they really kind of galvanized the industry to kind of improve their processes, their controls, understanding who these third parties are, what they're doing for their money, is what they're doing commensurate for what they're being paid, and really kind of forcing the firms to get a proper process and KY or know your third party processes in place, risk rating, understanding what you're paying away. In my experience, there was a complete kind of black hole there, and there was huge numbers of these sort of local introducers being used, maybe receiving very high percentages of commission for introducing business, for potentially not doing very much at all, and limiting the broker's ability to actually access the underlying insured, because it was all through these agents, and that obviously creates it's a very significant corruption risk. These entities are often unregulated. They, as I say, have this kind of closed or restricted access to the insured parties, and it's really just a case of ensuring that the systems and controls around these entities are strong. That's the major defence for firms against the Bribery Act, for example, the UK Bribery Act. So understanding what they're doing for their money, you know the value that they bring to the relationship, and that what they're being paid is commensurate with the actual work that they perform. Having contracts in place with strong anti-bribery and corruption clauses, having reconciliation on payments that go out to them. I've seen again historic issues with training funds set up for some of these firms, where the money was put aside for maybe some senior individuals within these introducers to have training, and actually it would be slush funds for holidays, for entertainment and things like that. So again, it's having that control and understanding that actually you're just paying away within the terms of the contract. You're not setting up additional monetary deposits that these entities can use as well.
Yeah.
So I was going to say, in terms of the sort of improving controls, yeah, I mean, absolutely, they are improving. There's still a way to go as within any industry. But from my experience, I think firms are far more proactively attempting to stay on top of the sort of emerging ABC risks these days than they were.
Okay. Thanks, Mark. It does look as if there's a real need for everybody to have strong controls, processes, and systems, as you said, to keep on top of all of these risks, particularly around bribery and corruption. And you're echoing what Steve said earlier, which is great. Marie, if I can turn to you now. Besides bribery and corruption and sanctions, which you mentioned earlier, I was wondering if you could elaborate on some of these themes of sanctions risks for our audience, and if possible, some real life examples that you've come across in your many years in the industry. I think we may have lost Marie there. Linda, if I can turn to you instead, if I wanted to find out more about financial crime risk appetite across the insurance industry, how does this feature within the overall financial risk appetite and strategy of an insurance company, and what are your thoughts on this?
So I think that financial crime should be incorporated into any firm's enterprise risk management framework, because to do that, you then can set yourselves an appetite, monitor against that appetite, and provide governance around the operationalisation of appetite. So we have done that in Aon. We have financial crime firms as part of our enterprise risk management framework. We have instigated a particular risk for each type of financial crime risk that we're exposed to, and attached to that is a relevant KRI, so key risk indicators with appropriate defined thresholds. That allows you to measure your appetite, and there's an overarching statement which talks about the overall appetite to financial crime, and then subsets, more information on each subset as it goes through. Financial crime risks at Aon are high on the group agenda. We always have risks at PLC board level, which is our highest level. And on top of the general ERM framework positioning, we also have financial crime risks. I think we currently have 2 in the UK that are our top tier risks. So I guess all of that, bringing all of that together. Oops, I forgot one more thing. We also have different appetite statements for certain areas of financial crime. So we have a risk appetite statement for our third parties. That's our third parties who introduce business to us. We have a risk appetite statement for our clients, and we have a risk appetite statement in respect of sanctions. So while we are in the main absorbed within the wider firm's ERM framework, where we need to have those additional bits. We do have them in place. And I think it's that multi-layer approach which it just ensures you have sufficient coverage of all risks and ensures that the financial crime risk remain at the forefront of the business's minds when they're looking at all their other risks. So because they are there, then they inevitably form part of strategy and planning. What's also really useful is if people have a product oversight and governance group, so when you're looking at new products, new services coming to the forefront, get a seat at that table as well, because that's where the risks start to maybe change from what your risk assessment might, or because you should all have a risk assessment, from what your risk assessment might tell you. So, and at that point, it's much like for those of you who maybe dabble or work closely with privacy people, they have a saying of privacy by design. But we need to now do financial crime by design. So the sooner you get around that table when the business are talking about wanting to go and offer this in this country, wanting to design a new website, whatever, you then need to make sure the financial crime risks are there. So don't just rely on your framework. Get to the table would be my advice.
That's great. No, in the discussions that I have with our clients, we discuss that financial crime risk is part of the overall financial risk of an organization. So as you say, when you're going into different countries, consider what the financial crime risks are when going to that country, dealing with customers and suppliers, as well as the government environment that you're working in. So that's very true. Marie, can I come back to you? I think we've got you back online.
Hopefully. Sorry.
You spoke earlier about bribery and corruption and sanctions, and that sanctions is particularly high risk in the insurance industry. Could you elaborate on this risk? And if you've got some examples that you can share with us from your many years of experience, that would be really helpful.
Okay, yes. So sanctions risk. So firstly, the main issue is the frequent changes in sanctions and the number of sanctions regimes. If you operate in more countries, in more than one country, or if you're global, whether you're US owned, US based or not, there are plenty of US sanctions regimes that will apply to you of that as well. So the frequent changes and the number of regimes is complex, and that is particularly also if you work in or provide services to several industries and locations. So my company, Willis Towers Watson, we've got a large Russian office, we've got a large office in China. We're very active and leaders in marine energy, so natural resources, oil and gas, aerospace and financial services, as well as large-scale construction such as highways and other infrastructure. And then also we are a very large broker in the reinsurance sphere of everything. So we have to consider the trade sanctions risk that might not be targeted at the insurance industry or insurance brokers, but targets the industries of our clients whom we are supporting and providing services. So you think you have a handle on it and your business is really clear on what is and is not permitted. You think like you've got it all sorted. You've got oversight. You're reviewing your business's transactions for sanctions risk, and then boom, there's a sanctions change or a new sanctions altogether comes in. It is not even a sanctions regime that you were operating on or considering before. So your first step as the compliance sanctions team is one, keep your BAU business going, because you can't drop everything to deal with the new sanctions. But then you need to very, very quickly get on top of the new sanctions, change your process, educate your business, and look for the new business impacted. You'll also need to look back at existing business that you've already placed and approved prior to the change in sanctions or the new sanctions regime to see if you have current approved policies or claims on those that might need to cease, or be wound down, or for which a future claim might be an issue, depending upon the regime. So in that context, I'm particularly thinking of trade sanctions risk targeting particular industries, such as oil and gas and energy, rather than smart sanctions regimes or dealing with individuals or entities who are named on a list. Your KYC process and your screening provider should rapidly flex to changes in list-based regimes as they simply add the new list to their suite of hundreds of lists that they screen against, and start screening against the new list or start screening against the new names on the list. This is why you not only need to be doing onboarding KYC and screening, but ongoing screening of your existing client base so that you are tracking any changes to their status after you've onboarded them. So if you've got a strong KYC process and a strong screening provider, responding to smart sanctions changes should be relatively easy to manage. Also, you'd think there has been an increased incorporation of ownership and control extension sanctions to not named parties, and this poses a significant due diligence challenge for businesses and compliance. There could be complex corporate structures. You might be having to look at or rely upon unreliable or untransparent records in many countries, and so that means that the due diligence for you to be satisfied that a party is not owned, or even more challenging, controlled by a sanctioned party, is time consuming and a significant burden for many companies and for compliance teams. And you're often having to do it under time pressure to place or renew a policy or pay a claim or face an E&O risk. If you can get a clear answer in time, whether it's a yes or a no, that's great. But if not, then you are taking a serious risk to approve a transaction proceeding without being able to get satisfied on that due diligence. But coming back to trade sanctions and sanctions targeting particular industries, and you want some sort of real life examples. Trade sanctions in insurance requires a review of the transaction as a whole, and a lot more information which may not have been provided for a normal broking placement or for conducting KYC. So you have to ask for a lot more information, which if this is a new client or a new sanctions or a new trade for the client, may come out of the blue for them and they may resist doing that. It doesn't always mean that there's something wrong or they're trying to hide something. They just might be going, you haven't had to ask, I haven't had to provide this information before. Why are you asking it for? Why are you asking for it now? So, a real live situation is I still have shudders about a not long ago period in the Iran sanctions regimes when trade was permitted, even encouraged, but was still restricted. And particularly there were certain items of goods which were prohibited. And my team were having to review multiple page manifests, often in languages we did not speak or read, or in technical languages, to search for prohibited goods on the manifest before approving our company broking any voyage or flight or land transit to or from Iran. I mean, that was really difficult for us to do and manage. But I think one of the things is that even in periods of stability in sanctions regimes, and we have had a few of those over my career, the big challenge, and it's become an increasing challenge in recent years, is that insurers and brokers do have different exposures due to their different roles in an insurance transaction. And the particular challenge is that there are numerous parties involved in a placement, each of which, due to their own geographical location or corporate structure, may have different sanctions obligations from others. So you could have a lead insurer that is perfectly legal for them to underwrite a piece of business, but some of the following market might have a problem because they're located somewhere else or they're US owned. And then that's complex enough to manage. But for many parties, their sanctions risk appetite also needs to take into account not just their own sanctions exposure or risk appetite, but key business partners, such as their banks or other service providers who are essential for them to actually engage in the business. So with that, I hope the audience can sort of see the possibility of a single sanctions risk in a single end transaction could give many different risk and risk appetites between the parties involved, which is why everyone involved in the transaction, not just the broker or the lead insurer, needs to assess their sanctions exposure and make a decision before proceeding. Because if you defer that to a broker or defer that to your lead insurer and they accept something that is illegal for you to engage in, that's no defence.
Wow, that it seems extremely complex, and as you say, it's like a spider's web. And when you start delving into it, that sanctions screening is extremely complex. Then, when you're looking all the way down the chain of relationships, Mark, if I could turn to you, please. How would you assess the industry's overall capability and maturity when it comes to financial crime prevention? And by that, I mean the control environment in which they implement in their organization and the controls that they implement against specific financial crime threats. For instance, you previously mentioned during our research process that the second line of defense function across the large insurance firms actually works quite closely together to share both challenges and best practices.
Yeah, and I think it's fair to say that the larger firms are more advanced than the smaller firms, partly due to the maturity within the firm and subsequently the available resources that are available within those second line functions, but also partly due to the regulatory scrutiny. The regulators do tend to focus on the large organisations, and that makes, as a default, means that they up their game a little bit more. And I think it's worth saying that, unlike what you see in the banking sector, where there would be economies of scale in terms of bringing in, large scale systemic improvements, which may reduce otherwise, significant amounts of headcount, maybe in offshore centres. The insurance industry doesn't really have that same justification for bringing in those same kind of processes. They don't see the same cost benefit that tier one banks might, for example. So a lot of things that are more manually in the insurance sector than you might see in other areas of financial services, and obviously manual processes are more likely to require more people and more likely to create errors potentially. That being said, I think it's screening processes are even vastly improved from when I started in the insurance sector 12, 13 years ago now, and to what I see speaking to people these days, and certainly what it was like when I sort of moved out of the industry a couple of years ago, in terms of enhancement, in terms of the comprehensivity of screening of client databases, third-party databases, the ability to screen all the parties in a chain, as Marie was talking to, the complexities that come around that from a sanctions perspective. Again, there's quite a way to go there because of the difficulties in the lack of information that may be stored on a system. But again, things are improving, and I think one of the key challenges that sits with any firms is data quality as well. And if you've got bad data quality, obviously your ability to screen effectively is significantly affected. So again, I've seen moves from firms to try and improve the quality of their data, the amount of data that they hold on systems, to be able to actually then increase their ability to screen effectively. And to your second point, Carol, so I mean, certainly it's one of the things that I've experienced in my time in this sector, is that how kind of well the firms work with their peers across both broking and the general insurance sector, both kind of within broking, the head ofs regularly kind of sharing challenges that they're seeing in the sector, what they're doing at a high level to kind of meet those challenges, and then particularly around the sanctions side of things. There's some really strong and good roundtable events that I know are kind of held that really kind of allow firms to try to get to the nub of those challenges that Marie was just talking about, and trying to actually work out how each of the players within the chain can actually try and meet their obligations, and to try and make sure that everyone is as much as they can singing from the same hymn sheet. But again, as Marie said, that can be challenging given that different entities may be subject to different regulators or regulations. But it does, I've certainly seen that will within the sector, and I think that can obviously only help and continue to that kind of collegiate approach is to be strongly commended, really.
Mark, thanks. As you said, a lot of it comes down to systems, processes, and experience. So there's nothing like having the right controls in place to be able to manage these different threats that you're dealing with. Steve, if I can turn to you now, something that regulators and firms alike are increasingly emphasizing is the value of data and technology in financial crime risk management. And this is something that Mark mentioned just now. Could you tell us a bit more about applications of anti-financial crime technology that might be particularly relevant to the insurance industry?
Sure. So, I know I mentioned before the need to automate, especially with extreme external events such as COVID. And, invariably people are saying, I don't want to change, but doing things this way for 10, 20 years. And I'm, it's kind of the same way. I still send out bills with stamps on them. So I understand it. I get it. Why there's, such a, thought process in place that maybe if we do switch over, we'll be cutting staff and there won't be a need for as many great compliance professionals, and nothing could be more wrong. And I definitely want to illustrate that. So really the fact of the matter is increasing volumes, ever increasing surge in available data. It's made things impossible from a human only standpoint. There's just millions of clients, billions of data points. To say things have changed is a huge understatement. But the key thing is you can't just toss around buzzwords like AI, machine learning, natural language processing. It sounds good. It's like when you say, I can just write something off, you sound like a tax expert, but at the end of the day, you may not know exactly what that means. So there really needs to be a strong human element present in really any automation. We use a phrase, essentially, it's common in the industry, authentic intelligence, and it helps kind of illustrate this. So AI technology obviously can analyze a vast amount of data, identify patterns in those data sets that a human just cannot do. So AI can answer the who, the what, when, where, and how. It cannot and will not ever be able to answer the why. And that's really the most critical piece to law enforcement, to any type of investigation, to really the greatest value that compliance professionals provide in putting, I want to say a stop, but certainly putting a hamper into financial crime. So, when it comes to the all important why, there'll always be the expert researchers, analysts, investigators who need to exercise their judgment, their expertise to connect the dots that AI provides. Mark mentioned that kind of need for good data. And it's kind of, a bit of a hackney phrase, but, garbage in, garbage out. So, as powerful as AI technology can be, one of the key blind spots is identifying fake or inaccurate news and information. So an AI system, even the best of the best, is ultimately only as good as the data feeding into it. And even the smallest of flaws will make those decisions unreliable. And in fact, the more clients, the more data points, those seemingly small flaws can definitely balloon to major issues. So therefore, businesses need to make sure their data is coming from carefully curated, verified, licensed sources. And that's where the human expertise comes in. So a machine cannot determine which source to leverage, how to access it, but it's the subject matter experts that know where to find the most reliable information to really feed the AI platform. Also, a given model is not smart enough by itself. The machine's only as smart as you train it to be, and only as material to your particular FI risk as you train it to be. which is important. A common theme we're hearing is that you have to be able to understand the risk, to have a risk assessment, and not just kind of treat everything with a broad brush. So what may be a good AI model for a large FI certainly wouldn't be for a small one, for one in the US versus one in maybe a higher risk jurisdiction. So definitely not taking that one size fits all approach is well advised. One additional important thing to consider is that it's never acceptable, as many of us here know, that to tell a regulator, oh, we use AI technology to make our decisions, and expect them to say, okay, nod their head and say, that's great, good to hear that, we'll see you next year. Not the way it works. So the decision-making process will need to be explained, just as it always has been. So when you look at AI solutions and the algos that are tied to them, they can't operate in secrecy, in a black box. It's just not going to work when you're trying to explain or sitting across from a regulator how you're going about making decisions, especially when these decisions produce legal effects. So that's why it's really important for compliance professionals to be a part of that decision-making process. So really, to kind of sum things up here, any responsible compliance program will never be fully dependent on AI. Again, AI is great in providing the data and giving those dots, if you will, but that's all they are at the end of the day. You need those human experts, whether they're research, like law enforcement professionals, analysts, to say, okay, we have this mass amount of data now, let's bring it together in a way that makes sense.
Steve, thanks for that. You're highlighting another issue, which is there's no how do you call it, recipe for just relying on systems, but human experience is key for interpreting the data and information that comes out of those systems. In the interests of time, this has been a fabulous discussion. I'd like to move on to the Q&A. From the audience, we've had many questions come in from the audience, and I would like to first of all direct a question to Mark. This is from Sajuta Gasgupta. How different are insurance frauds from banking frauds? Can some of the banking fraud prevention mechanisms, processes, and platforms be used to monitor insurance fraud as well?
So I think there's quite a disconnect at sort of the initial level between what you might see, or the majority of the type of frauds you might see within the insurance sector to within banking. A banking fraud would typically be, and obviously there'll be a lot of variation in this, but I guess if you ask someone what their expectation would be, it would be where an individual, your or my account is maybe cloned, and someone has access to your own personal funds and is maybe able to defraud that individual of money from within their account. And then, the hope or expectation is that the bank, the organization, might then, make that individual, the victim, good on any lost funds. Within the insurance sector, of course, this tends to be, fraudulent claims, the most common thing I think that we probably all expect, which could be, the client directly making a fraudulent claim on their insurance policy. It could be a third party attempting to claim, again, if they've stolen policy details on behalf, and redirect the money to a third party account. So they tend to be sort of at the base level quite different, but I guess that you've always got money moving from A to B, and you can kind of always to a certain point follow the flow of funds. So banking fraud mechanisms, banks would have in extensive transaction monitoring, screening processes and platforms in place, which would look at a number of a wide range of factors, from unusual activity on a client's account compared to what you would normally expect to see. Certain activity may be taking place in one geography compared to another geography on the same day. Certain things like that. Certain triggers that would indicate that untoward activity is taking place. Now, a lot of the time with insurance, you just won't have that level of information. You won't have access to, obviously, a bank account, which provides a lot more sort of information that can be screened against than an insurance policy, which you've just typically got premiums coming in and maybe a history of claims. So there are, without the ability to potentially go into specifics, there are potential leverages that could be used and existing transaction monitoring systems that could be adapted and potentially simplified to apply to fraud. But I think you'd be looking more for a fresh kind of take on things when you're looking at insurance fraud mechanisms, basically, and screening tools to what you'd see in the banking sector.
Thanks, Mark. And I hope that has addressed the question from one of our audience. Linda, if there's another one that's come in, which I think this is definitely one for you. What's the experience of managing potential sanctions exposure within a business unit to satisfy the wider business or customers based within a higher risk territory or the regulator risk appetite differences? And this one's from Sailesh Rana.
I think I'm going to ask Marie to answer that one, because sanctions in business units isn't something that falls within my remit.
Okay.
Oh, sorry, can you repeat the question?
I will repeat the question. What's the experience of managing potential sanctions exposure within a business unit to satisfy the wider business or customers based within a higher risk territory or the regulator risk appetite differences?
I'm not sure. I'll start with the end first. I'm not sure the regulator risk appetite differences is what drives that, because there is a difference between sanctions regimes. So the EU sanctions regime and the OFAC sanctions regime do differ in a number of places, and sometimes they come together and they apply the same way, but then they many of the time they do conflict. And so you have to look at which sanctions regimes apply to you or apply to parties that you're working with, and follow all of them. And obviously if one of them has more penalty than the other, I'm particularly saying OFAC here, if there's more consequences from that, then you comply with that. If you're exposed to that in the transaction, then you follow that. I think with the experience of managing potential sanctions exposure in a business unit to satisfy the wider business, I don't separate the two. If you've got sanctions exposure in a particular part of the business, that sanctions exposure is to the whole company. So, if I sort of think about our reinsurance business, they have a lot of sanctions touch points because of the volume of the business that they cover and the volume of industries that they cover, and ultimately most transactions somehow end up in reinsurance. We have different processes to help them manage their sanctions risks so that we identify and address it to deal with the volumes that are there, but we don't view it as their risk. It's the entire company's risk. If we miss something in the reinsurance business unit, it won't just be them, it will be the parent company and the entire corporate group who will be exposed. So I think if you only have a business unit responsibility, you should be managing the risk in your business unit, but also working with central or global or all business leadership to make sure that you are all together cooperating in a network to manage sanctions risk. I hope that's answered the question.
Thank you, Marie, and I hope that addresses that question. We seem to be running out of time. The hour is nearly up. I want to say thank you very much to Linda, Marie, Steve, and Mark for your time and your insight into your experience of addressing financial crime risks in the industry. It's been fascinating, and I know we could go on for many more minutes. to address a lot of the different risks. And personally, I'm quite interested in the sanctions risk and the entire chain that you have to evaluate to fully understand where your risks lie. For the registrants and the audience attending today's call, I mentioned earlier, a white paper that is going to be ready next week, and it will be distributed to everybody that's registered for today's webinar. A huge thank you to Dow Jones, to their support in shaping our joint research, and to the technical team that has really worked tirelessly to set up this webinar. It's been a real pleasure not only to meet and talk to Linda, Steve, Mark and Marie, but also to everybody else that's been part of this webinar. And I look forward to all of our upcoming initiatives together. When I say that together, I mean with Dow Jones, and particularly our next webinar, which is a spotlight on financial crime risks in the Middle East, which will take place Monday of next week. So without further ado, thank you very much. And I look forward to seeing you all at the next webinar that we host.
Thank you.
Thank you, Ron.
Thanks, everyone.